While Tesla continues to dominate headlines and investor portfolios, there's a powerful underdog rising fast in the EV space, NIO. Based in China and backed by innovation, government support, and global expansion, NIO might just be the most overlooked EV opportunity heading into 2025. But can it compete with the giants, or even outshine them? In today's video, we're breaking down NIO's latest moves, its upside potential, and whether it deserves the title of Best EV Stock right now. Before we hit full throttle, smash that like button, subscribe to Stocks Telegraph, and drop a comment below. Do you think NIO is flying under the radar or already overhyped? NIO is far more than just another Chinese EV startup. It's building a premium identity that combines sleek design, cutting-edge tech, and a futuristic ownership experience. Think of it as a fusion of Apple's ecosystem with Audi's luxury performance. Whereas BYD dominates mass-market volume, XPeng leans into autonomy, and Li Auto plays the hybrid game, NIO stands out with innovations like Nomi, its in-car AI assistant, and its high-end interiors. From customizable lighting systems to advanced driver assistance, NIO is crafting an experience rather than just a product. NIO isn't trying to win a price war, it's crafting a lifestyle brand. NIO's battery swapping tech has drawn plenty of buzz and some skepticism. With over 3,000 power swap stations in China and expansion underway in Europe, NIO's 5-minute battery swaps aim to solve the range anxiety and charging delay problem. Its battery-as-a-service model separates battery ownership from the car, making vehicles cheaper up front while offering battery flexibility over time. Yes, infrastructure is expensive, and only a fraction of swap stations are profitable. But its partnership with CATL to scale to 10,000 stations in China shows commitment. If NIO achieves scale, this infrastructure could become a significant moat, offering convenience Tesla can't match. Some analysts even argue that if successful, NIO could become the Amazon Web Services of EV battery infrastructure. NIO isn't staying domestic. It has expanded into Germany, Norway, the Netherlands, and other European nations, rolling out models like the ET7 and ET5 with flexible ownership plans. By 2025, NIO plans to build 1,000 swap stations outside China, most in Europe. Despite delays, like the Firefly EV's postponed launch and EU scrutiny over subsidies, NIO pushes forward. It's also going global with R&D. In the US, its new headquarters in San Jose is now operational. In the Middle East, it's developing an AI research center in Abu Dhabi. Hiring globally, and with employees from 24-plus countries, NIO's ambitions are unmistakably international. The company even launched language-specific support teams and localized driving modes to tailor its user experience to each market. In the fourth quarter of 2024, NIO delivered 72,689 vehicles, a 45% year-over-year jump, powered by its flagship brand and ONVO line. Revenue hit $2.7 billion, with vehicle sales making up $2.4 billion. Gross margins climbed to 11.7%, up from 7.5% a year ago. Yet, the company posted a net loss of $974 million for the quarter, reflecting continued R&D investment and high SG&A costs. Still, NIO ended the year with $5.7 billion in cash, enough to weather the current volatility. On the plus side, management expects margins to continue improving in 2025 due to better battery costs and higher ONVO production volume. NIO is growing fast, but profitability remains a long-term goal rather than a near-term reality. Institutional moves show mixed sentiment. UBS raised its stake by 975% in the fourth quarter of 2024, and Morgan Stanley added significantly too. However, some big names like Millennium Management and FMR scaled back. On the analyst front, JP Morgan downgraded the stock to $4.70, while others issued buy ratings amid delivery and margin improvements. The consensus 12-month target now sits around $5.12. This divergence reflects the broader uncertainty around Chinese EV stocks, but it also points to upside if sentiment turns. Recent rumors of potential partnerships with European automakers could be a future catalyst for renewed Wall Street interest. Imagine a future where NIO's vehicles dominate global cities, supported by a seamless battery swapping network. That's the dream. NIO plans to double deliveries in 2025 and sees its swap business breaking even by 2026. Europe is key, with Firefly aimed at competing with BMW's Mini and Mercedes Smart, and premium models in Germany and Norway, NIO could challenge Western brands directly. Its infrastructure-first model gives it a differentiator that's hard to replicate. It's also expanding its services model. NIO house locations blend coffee shops, co-working spaces, and test drives. The idea is simple. Build lifestyle loyalty, not just brand loyalty. If battery swap scales and margins continue improving, NIO may finally earn the nickname Tesla of China, with a valuation pop to match. But let's not gloss over the risks. China's EV market is deep in a price war, pressuring margins and pushing even strong players into lost territory. NIO's own net loss hit $700 million in the third quarter of 2024. In Europe, rising tariffs on Chinese EVs make expansion costlier. Regulatory changes across regions add uncertainty, while execution delays like Firefly's launch highlight operational hurdles. And while battery swap tech is promising, it's also capital intensive. Scaling it globally without burning through cash could prove difficult. There's also the risk of competitors leapfrogging with faster charging technologies that make swaps obsolete. Technically, NIO's chart looks weak. At $3.60, it's below all major EMAs. RSI sits at 42.6 neutral, but MACD momentum remains bearish. Resistance sits around $4.20 to 5.30, with support just above 3.40. Retail sentiment on Reddit and StockTwits is split. Some are excited about the long-term vision, others doubt near-term recovery. Institutional ownership is still strong at 48.5%, despite recent net outflows. The stock is trending in bearish territory, but a catalyst, like an EU partnership or surprising earnings, could spark a technical reversal. NIO is more than an EV manufacturer. It's trying to build a global AI-integrated transportation ecosystem. With a premium brand, expanding infrastructure, and a vision that reaches beyond China, it's arguably one of the most innovative players in the EV space. But it's also in a tough spot, trading at multi-year lows, burning cash, and facing regulatory uncertainty. Still, its technology, expansion efforts, and improving margins offer real potential. For long-term investors who believe in the global EV shift and want exposure to infrastructure innovation, not just vehicle sales, NIO could be an asymmetric bet worth considering. Just understand that the road ahead will be bumpy. So, what's your play on NIO? Are you bullish on its global ambitions and infrastructure-first strategy, or skeptical about the risks still lurking under the hood? Drop your full NIO thesis in the comments. We read every one, and your insights might shape our next deep dive. And if you're into sharp global investing takes, whether it's EVs, energy, or emerging tech, make sure to subscribe to Stocks Telegraph for more data-driven market breakdowns. Don't forget to like this video, hit the bell, and stay plugged in, because when the next EV surge hits, you'll want to be ahead of the curve.